The broadcast is now starting. All attendees are in listen-only mode.
Hello everyone, and welcome to this new BISAM webinar on digital strategies in asset management. My name is Bénédicte Godet, and I am the Marketing Director at BISAM. Thank you all for attending this webinar. I hope you will find it both informative and entertaining. Before we begin, I'd like quickly to introduce BISAM. We are a global leader in performance, attribution, risk, and reporting solutions, and our award-winning platform has been adopted by financial institutions around the world. Founded in 2000, BISAM has grown to all quarters of the globe, with presence in most of the key financial markets globally, like Paris, London, New York, Boston, Hong Kong, Singapore, and Melbourne. 2013 marked the sixth consecutive year which we were awarded the best performance, measurement, and attribution solution by Waters Technology. Today's webinar will feature Peter Ellis. He is the Managing Director for Strategy and Marketing at BISAM. Thanks for joining us today, Peter.
My pleasure, Benedict.
The webinar will consist in a 20-minute presentation, followed by live Q&A from you, those of you online. We invite you to ask any question by submitting them in the window marked Questions within the control panel of your screen on the right. We will do our best to answer all the questions in the time we have. I will be receiving those and asking them to Peter at the end. Without further ado, I would like to pass it over to you, Peter.
Thank you, Benedict. So here's the agenda for our discussion. First, we will look at some of the macro challenges facing the industry. Then we will look at digital channels in general and debunk some of the myths around them before moving on to look at how they are already being used by investment managers. Then we will look at some of the issues that are having a specific impact on performance and client servicing teams. And we will finish by looking at how digital channels can be used by managers to deliver a step change in the client experience without having to increase headcount. Now, the asset management industry is facing significant challenges. This is particularly true for investment management firms who are experiencing a sustained period of reduced margins extending back over 5 years. This pressure on margins is creating conflicting priorities for managers. On the one hand, they need to reduce operating costs. On the other, they need to enhance the client experience in order to retain clients. Now let's look at this in a bit more detail. Let's look at the cost pressures first. There are two main ways to reduce operating costs. You can reduce service levels, or you can introduce economies of scale into business processes. Now, managers cannot reduce service levels because of the need to enhance the client experience. Economies of scale are usually achieved via the automation of standard processing. Standardization of business processing usually results in commoditized services, and introducing a commoditized service is not the best way to enhance the client experience. So let's look at how you should go about enhancing the client experience. There are two main approaches to this. The first involves raising service levels by delivering the same service in less time or at a lower cost, or by delivering a higher volume of services in the same time or at the same cost. The second approach involves delivering a more customized or tailored service. So what's happening is that the drive to reduce operating costs is taking managers towards more commoditized servicing, which is incompatible with the need to introduce a more customized client experience. But why is this such a problem now? Well, it's because the industry is still struggling following the global financial crisis of 2008. When the crisis hit, investment managers were just recovering from the effects of the collapse of the dot-com bubble at the end of the 90s. And the global financial crisis pitched managers right back into a large hole. Regulators have introduced much more demanding regimes, and this has increased operating costs and consumed change budgets over the past 5 years. There was a breakdown in trust between investors and investment managers, and investors are less loyal now than used to be the case. And so it's become harder for managers to win and to retain business. And investor expectations have shifted significantly. They are more risk-averse, demand more transparency, and want more evidence of the value that managers are actually. In summary then, managers are under more pressure than ever before to keep operating costs under control and differentiate themselves in a crowded marketplace. But they can no longer rely on promises to deliver good performance returns as the key differentiator. They have to show clients that they are delivering. But before we continue, let's just give a couple of definitions. When we talk about digital channels, we mean delivering content in a wide range of different media, including HTML, audio, video, and apps, without the use of physical media. Delivery is via the internet, either directly to the target audience via email or indirectly via websites and social media. A digital strategy is a description of the way that a firm plans to leverage digital channels in order to enhance its business. The scope of a digital strategy can extend across all client-facing activities such as marketing, sales, and client servicing. Typically, a digital strategy will define the business objectives that are to be achieved, the digital channels that will be leveraged to achieve the objectives, and the type of engagement that will be delivered via digital channels. Digital channels have become extremely pervasive in all of our lives, to the extent that many of us now take them for granted. This slide shows you just some of the many examples of how all of us are using digital channels throughout every day of our lives. And there are many other examples we could have used, such as Facebook and Twitter. Activities like booking hotels and flights, buying all kinds of consumer goods, watching movies and staying in touch with friends can now all be completed without paper documents, without cash, and without person-to-person contact. And what's happening here is that digital channels are being used to deliver a step change in client experience. Nowadays, it is possible to have active, frequent, cheap communication with your friends and family on the other side of the world through digital channels like Facebook and Skype. And compare that with 10 years ago. Albert Einstein once said, "Never memorize something if you can look it up in a book." And there is now a modern manifestation of this sentiment, which is known as the Google effect. The Google effect is changing people's expectations of service delivery. Today, I can get the answer to any question by using my mobile phone while traveling on a train, going from anywhere to anywhere. And this is having a massive impact on the expectations of people regarding the levels of service that providers should deliver in all walks of life and business. We all expect more complex information to be supplied on demand and in a way that is more tailored to our individual needs. Failure to meet this expectation is seen as diluting the client experience. But is all of this really relevant to investment managers? Are digital channels really important in our industry? And the answer is very definitely yes. Many examples can be cited to show how a broad technology trend that is significantly changing social norms is changing the way that investment managers engage with their clients. Retail investors use web-based platforms for investing in mutual funds, ISAs, and other types of investment vehicles designed for direct investment by individuals. This is an extension of retail banking, where digital channels are becoming the norm for banking customers. A recent global research study by Booz found that 76% of global wealth management clients access information about their bank accounts via tablets, and 56% do it via smartphones. In fact, it is in the traditionally conservative world of wealth management that the move towards digital channels is really gaining traction. Hargreaves Lansdown is a UK firm specialising in wealth management with £40 billion of assets under management, and they have recently stated that 55% of new business comes through digital channels. Having said all of this, it has to be accepted that in the institutional world, digital channels are not used to the same extent as in the retail and wealth management sectors. But this is changing, and the use of digital channels is more pervasive than you might think. Look at this slide. All of the top 10 global managers are using LinkedIn. 8 of them are using Twitter, and half of them have a presence on Facebook. In fact, what we will see in the institutional space is an extension in the use of digital channels rather than the introduction of digital channels. And here, just like in the retail world, managers will be able to use digital channels to implement a step change in the client experience without increasing operating costs. Now at this point, I'm reminded of a quotation from Abraham Lincoln. Things may come to those who wait, but only the things left by those who hustle. When it comes to extending the use of digital channels, investment managers have a choice. They can wait until they are forced by a critical mass of clients to integrate digital channels into client servicing, or they can accept that the world is changing and try to get ahead of the pack. Those who are proactive in this area can expect to reap real benefits. To understand why, we're going to introduce here some specific meanings for the terms client and consumer. Now, a consumer is an intermediate point in a client servicing process. They receive information and then pass it on to someone else. But before passing it on, they usually process the information in some way. They may enrich it, they may reformat it, they may repackage it, and so on. A client, on the other hand, is an endpoint in a client servicing process. They receive information and process it for their own needs. They do not pass it on, changed or unchanged, to anyone else. Now, both clients and consumers can be internal or external. But there's an important difference between consumers and clients, which applies regardless of whether they are internal or external. With clients, there is usually an agreement of some kind as to what has to be provided, when, in what format, and to whom it should be delivered and how it should get there. A typical example of this is a formal client report for institutional investors. But because the work required to service clients is known in advance, it can be scheduled. But this is not always the case with consumers. They require much more flexibility. They can request different types of information to be delivered to different people in different formats at different times. And these ad hoc requests are very difficult to process efficiently on a large scale because the workload cannot be predicted. Therefore, by their very nature, consumers require a customized service. Customized services usually require a high degree of manual processing, which does not scale up to support high servicing volumes. Now here we show some of the main examples of internal and external clients and consumers. You will see from this slide that although the definitions we are using here may be new to you, the concepts behind them are not. There have always been consumers and clients inside and outside firms, but what is new is that behaviours and expectations are changing. The effects of the global financial crisis in 2008 are changing the fundamentals of the engagement models for clients and consumers. Requests for performance information are growing in number. A wider range of information is being requested. The requests are becoming more complex in nature. They are being received more frequently, and the information has to be delivered sooner. Consumers, internal and external, are becoming more important and more influential, and their behaviours, the ones that require customised servicing, are becoming more prominent. These are irreversible trends, and the pressure on investment managers are only going to intensify in the future. Performance teams and client servicing teams have always had to deal with ad hoc requests, but the amount of manual effort that is going into dealing with them is increasing. And this is where digital channels offer real opportunities for investment managers. Robust technology now exists that can be used to develop web portals. Web portals are very familiar to all of us these days. We use them when we shop online, when we book travel online, when we manage our bank accounts online. Investment managers have been using web portals for some time to engage with retail investors. But the same technology can be used to provide consumers with a dynamic user interface for accessing performance information directly. This self-servicing approach gives consumers the flexibility to decide what performance information they want to see and how they want to see it. For example, do they want it in a table or in a pie chart? And the dynamic user interface means that they can drill down into further detail. For example, by exploding one section of the pie chart. But the really important thing is that with a dynamic web portal, all of these requests are dealt with immediately. And it's now possible to make this functionality available on mobile platforms. The benefits here are mutual. Consumers receive a step change in servicing quality. And remember, consumers could be external to the management firm. In the case of a pension scheme, for example, the investment director employed by the scheme is often a consumer. At the same time, managers can reduce the FTE associated with responding to ad hoc requests. The technology exists. Managers just need to implement it. Now, digital channels can also be used by managers to enhance the client experience in the area of client reporting. The asset management industry remains locked into a report book mentality for client reporting. This is because it used to be the case that client reports had to be produced like books. The content was printed on individual pages that were then bound together and delivered via a postal service. Although many institutional clients still prefer to receive hard copy reports via the post, many are willing to receive them in PDF format, delivered via email. However, this is not changing the fact that the reports are still being delivered in book form. But an institutional client is a many-faceted entity. Take large pension schemes, for example. Within these schemes, there will be trustees, investment directors, risk officers, finance directors, pension managers, and so on. All of these individuals require information from investment managers. And because we are locked into a report book mentality, all of the information tends to be included in a single client report. This means that if someone is interested in the information on one page of a 15-page report, they have to receive the whole report in order to access that information. And this is just inefficient for both parties. These different roles require information at different times, and this creates two challenges for managers. They're under pressure to deliver the full report sooner, and they have to provide some of the information in the form of flash reports, because the full report won't get there in time for everybody. And this just creates twice as much work. Now, digital channels offer the opportunity for managers to deliver the content of client reports as a set of discrete information components. Each component would contain only the information required by the target recipient and could be delivered via the recipient's channel of choice: paper, email, web, dynamic portal. Now, of course, there will still be a need to deliver the whole report to some people, possibly in paper format, and possibly via a postal service. The point is not to do away with paper. The point is that digital channels offer the opportunity for managers to divide and conquer when it comes to client reporting. In this webinar, we've been looking at how digital channels can be used by investment management firms to deliver enhanced levels of servicing without the need to increase headcount. And I just want to draw your attention to the final observation on the conclusion slide and leave this thought with you as we move into the Q&A section. So Benedict, back to you.
Thank you very much, Peter. Before we get to the Q&A section, I'd like to remind everyone that there's still time for you to submit your questions. You can do so by typing your question within the questions panel, the questions window on the control panel. So we have received, however, a number of questions. So Peter, the first question we have here is, do you think it is safe to let people have unrestricted access to performance information?
No, absolutely not, and I'm sorry if I gave that impression. I think that we must always be careful about taking a self-service approach in allowing people to have access to performance information, but it's quite possible with modern technology to control the information that is made available on a self-service basis. So I think the methods, the techniques, the procedures, and the technology is there to control what information people do have access to.
Thank you. We have received another question. Well, it's more a comment, actually. I work with lots of institutional clients, and they all want reports to be delivered in paper format.
Yeah, that's not really a question. That is a statement. But I think what's behind that is that so people are saying, given that institutional clients still want paper to be reports to be delivered in paper, are they ever really going to move to some other format? And I think they will. I think it will happen in time. I think there is a reason why institutional clients want paper reports to be delivered. Sometimes trustees are operating for more than one pension scheme, for example, and so it would be very expensive for them if they had to print out reports on their own printers. So I understand this, and I think institutional clients will go on wanting reports delivered in paper format for some time. I just don't think that's the only way we should be looking to deliver reports.
Okay, thank you. So we have another question. Yeah, so we put PDF versions of client reports on a secure website, and clients can log on and download them. Most of them do not do this. They want the report sent via email.
Yeah, that's right, and actually I share their views on that, because when we put a PDF on a website, which is a secure website, they have to have a username and a password, and if all institutional clients often will have multiple managers that are providing them with a service. So if all the managers do this, let's say they're using 7 or 8 managers, then they've got 7 or 8 different usernames and passwords that they have to remember and log on. And they have to remember to go onto the website and get the report. So they have to remember when the report is going to be there. It's much, much easier and much more convenient for them just to receive the PDF attached to an email. But I think what we have to do is, in order to encourage people to go onto websites, clients to go onto websites and access information, we have to give them some added value. And that's where the dynamic web portal approach is coming in, because just putting a PDF on a website is not actually adding any value over sending it to them attached to an email. It's actually, there's less value attached to that because they have to do more work to get the report.
Thank you. So the next question we have, please assess how and to what extent the development of personal finance management and personal finance planning platforms will affect the asset management industry.
Yes, well, I think it's already having an impact on the asset management industry, because what we're seeing, wealthy people tend to be early adopters of new technology, and what we're seeing in the wealth management industry is that clients, wealth management clients, are really driving investment managers to deliver a much better service, a much more customized service, a much more dynamic service, and to provide web portals that will give them immediate access to their investments, information about their investments. And for some time, wealth managers were kind of dragging their heels on this because they were worried about disintermediation. They were worried about becoming separated from their clients. But actually what they found is that the opposite is happening, because with a really good dynamic portal, a wealth management client can engage with their manager 24/7, whereas their client, if they have to deal directly with an individual, they can only do it through office hours, for example. So what's happening in the wealth management world is that the introduction of these web portals is actually improving client retention rates rather than leading to disintermediation. And I think what we're going to see is that technology is going to seep from the wealth management world into the institutional world as people become more used to engaging with investment managers through these high technology portals.
So we have, I think, 2 more questions. The next one is, are you seeing the demand for digital strategy and digital reporting in the hedge fund industry, or more so with your traditional asset managers and investment managers?
I think probably more so in the hedge fund industry for the reasons that I gave in response to the previous question. I think that the people, the investors, the clients of hedge funds tend to be a bit more savvy, maybe a little wealthier, and they're more likely to be early adopters of new technology. In the institutional world, there is less client demand. So I'm not sure it's not so much the hedge fund management culture versus the traditional asset management culture. I think it's more about client demand and client pressure. So I think that's why we are seeing it a bit more in the hedge fund industry. But it is definitely a growing trend within traditional asset management firms as well.
Thank you, Peter. Last question. Do you really think that clients would want to access their reports on mobile phones?
No, I don't. I can't see any reason why they would want to do that. But I think the point is more that what I was talking about earlier was not necessarily putting the whole of a client report on a mobile phone, but more about delivering. I talked about delivering discrete information components, and there may well be bits of information that an investor, even a retail investor, may want to get via a mobile phone. For example, they may just be away on holiday, for example, and they may just want to get some information which is not a full client report, but some discrete piece of information about how their portfolio and their investments are performing.
So this is the end of the questions submitted. Thank you, Peter, for answering them. We have had one last question on whether we are going to send the PDF. Yes, we are going to send it. So thank you for this question. I'd like to thank everyone on the line for attending. You will be sent a notification on to when today's replay will be available, together with a link to download our white paper on digital strategies in asset management. You will also receive a survey. I thank you in advance for providing your feedback, as our objective through those webinars is always to provide solutions to help you and your business. Stay tuned for our next thought leadership piece, which will provide a best practice performance framework for performance measurement and attribution. Thank you for joining us today, and